Well, clearly he has a lot to say today, so let's get started. Thanks, Aaron, and to the CFA leadership team for inviting Austan and me to join you here today and share some thoughts that I know are especially important to everyone here in the room about key economic trends and the role of the central bank. Clearly, based on the introduction, Austan is the expert, but I look forward to prompting some questions and then fielding some questions that have been presented to us from the audience as well. As Aaron said, look at the list of issues that we're dealing with every day, and she highlighted many of those: inflations, tariffs, immigration, the jobs report, technology, global economic uncertainty, workforce needs. Any one of those could certainly fill our time. So let's get started.
Okay.
So, Austan, this audience is obviously familiar with the role of the Federal Reserve at a higher level than most people.
Yeah.
But would you share some of your additional insights on your position, your responsibilities, and sort of some of the things you've learned in the 2 years you've been there?
Okay. I've only been at the Fed. I was 30 years on the faculty at the University of Chicago. I'm an economist, researcher. That was my background. Coming on my third anniversary at the Fed. Why does Chicago have a Fed? It's because we have a structure of a central bank, which is unusual in the world. Because in 1913, just as today, people were deeply uncomfortable with the idea that Washington, D.C. alone, or Washington, D.C. plus Wall Street, would control the entire U.S. financial system and monetary policy with no input from the rest of the country. They created a system which has a D.C. component, the Board of Governors, and Jay Powell is the chair, but also there are 12 reserve banks spread around the country. And yes, there's some goofy stuff about it. They needed the votes of 2 senators from Missouri, so 2 of the 12 are in the state of Missouri, St. Louis and Kansas City, but they divide up the country. The Chicago Bank covers 90% of the economies of Iowa, Wisconsin, Illinois, Indiana, Michigan, heart of the Midwest. That's the most manufacturing intensive of all the districts, by far the most auto production of all the districts. And these reserve banks are much more operational than is the Board of Governors in D.C. There's a little less than 2,000 people work at Chicago Fed. Partly it's being a bank to banks, and we have payment systems. And one of the things I discovered is all the cash in the economy is printed by the Bureau of Engraving and Printing, but is distributed through the feds. And we have in the basements many tens of billions of dollars of cash in there. And we run machines every day in and out to give money to bank ATMs.
No pennies anymore.
Or taking them. No pennies.
No pennies
we don't have much in the way of coin. I wanted it to just kind of be in big piles and go down, but it's not. It's very organized. It was disappointing. We run bank supervision, or we have bank supervisors for the banks that we oversee. We go every 6 weeks to the FOMC meeting where we vote on interest rates, and that's kind of the most public part of the job. And we're very involved going around the district and getting economic conditions and input from people and playing a community development function. That's kind of what the Fed does. And I had heard it, but the most pleasant discovery has been the people that work at the Fed are absolutely believers. It is, as I say, the Fed's part of the universe is only this big. But in this part of the universe, it makes a huge difference. And if you go to the Chicago Fed or any of the other Feds, they feel like they work at NASA and we're putting people on the moon. And I always say we're 85% NASA, but we're 15% the DMV. And we kind of got to hold the 15%, in control. But that mission driven is a really big part of it.
So of the Federal Reserve presidents, how many of them serve on the FOMC? And you're one of them.
Okay, I'm going to go into the obscure voting rules of the FOMC. You show up if you're a econ or accounting nerd like me or like you. This is the coolest thing in the world. There's a huge table, and there are 19 members around the table. There are 7 governors from D.C., including Jay Powell, and then there are the 12 Reserve Bank presidents, and there's some senior staff of the Board of Governors who present kind of background material at the beginning of the meeting. It's a 2-day meeting. The shades come down so nobody can spy what's happening. You have, it's like you're in the situation room. Everybody's got to put their phones outside. You can't have anything in there. And day 1 is about the economy and day 2 is about the rates. And they're literally going to go around the table and it's going to be like, Jay Powell, what do you think about the economy? Governor Chris Waller, what do you think about the economy? And they're going to go around and everyone speaks their piece. Then at the end of day 2, when they vote on the rates, now there's a rotating cast in any given year. It rotates by year. The DC political appointees who have been confirmed by the Senate, they vote every year. The reserve banks are not government agencies, and they all have their own boards of directors. They're not political appointees. New York votes every year. Chicago votes every other year, rotating with Cleveland, and all the other banks vote every 3rd year. So they're constantly rotating who the voters are. In reality, almost all the votes are unanimous. So there is one sense in which does it matter who the voters are if they're all going to vote the same way? But that is misleading in the sense that if you look at the backgrounds of the 19 people around the table, they come from very different. I was an academic, economic researcher. There are a few economists. There are some people with banking backgrounds, markets backgrounds, business backgrounds, and you can see in the minutes and you'll see when the transcript comes out with a lag, word for word, everything that's said will be released. It's a fascinating body. And I always say, with no offense to the U.S. Senate, for the 21st century, I consider this entity the world's greatest deliberative body. And people take the job extremely seriously. It's not about electoral politics at all. It's all about the economy and what are the conditions, and that's what it's supposed to be. The law itself, the Federal Reserve Act, says that when setting monetary policy, we are to maximize employment and stabilize prices, and that's it. That's what we call the dual mandate. That's all we're supposed to be doing. Now, it's not always easy to do that, but all other considerations are not what's in our mind. It's how's the economy.
Well, let's do a little deeper dive on that, on the inflation, interest rates, and the labor market.
Yeah.
So the Federal Reserve lowered the federal fund rates to a target range of 3.75 to 4% at its October 29th meeting. Is that correct?
That is correct.
And that was, of course, influenced by the CPI, and which showed an annual inflation rate of 2.96. Broadly speaking, how is the Federal Reserve, or you personally, evaluating the inflationary pressures in the current environment? I know you can't speak directly to what will happen at the December meeting, but
what's going to happen at the December meeting?
What's going to happen? Like some insights.
Look, so first I should have said at the beginning, the rules say nobody on the FOMC is supposed to speak for anybody else or for the Fed in general, only for themselves. Okay, so I believe that one of the most important things is also one of the hardest things is get the through line on the economy. Figuring out the through line. It's not, I absolutely don't want to say, hey, the CPI came out and was X, the job number came out and was Y, therefore, what should the next monetary policy decision be? Because this has a lot of noise in it, and it's up and it's down. And that's even true in the market. It's kind of part of the job of the Fed is to be the steady hand. And if you go look in the market of what do they think the interest rate will be, that goes up and goes down into this. Every day something happens. The market is going like this. And if you look at the actual rates that we set, it's very smooth. So I think getting the through line is important. And the hardest thing we have to do is get the timing right when there are moments of transition, or figure out, is there a transition? I think for inflation, we have set a target of 2% inflation. 3% inflation is too high, and it's not. You can't. Oh, that's close enough. Let's be done. No, we as a body made a sacred promise that we're going to get inflation back to 2%. Now, that said, if the through line is improving, and in 2023, inflation way too high. I came in January of 23, inflation way too high. Mostly it's coming down all of 23, and mostly it's coming down for all of 24. Now it seems to have kind of stalled out, and if anything, given warnings of going the wrong way. So that makes me a little uneasy. That said, before we got into the bout of tariffs and inflation going the other way, I am one of the people who believes that rates can go down a fair amount, that basically we're at something like stable full employment, with an unemployment rate in the low 4s, which is kind of where we would think it would settle, that prices are were on their way back to 2%. And so I said I thought rates could go down a fair amount. I still basically think that, but with the addendum, it's kind of like, at one point I was younger, but I hired a trainer. And the trainer said, well, what are your goals? And I said, well, do you think I could get a six-pack? If I did enough weightlifting, could I get a six-pack? The trainer said politely, we all have a six-pack of muscle underneath. And the message was, it's not about how much weight your muscle can lift. It's about what's on top of those muscles. And I feel a little bit like that here. We've got a series of geopolitical and policy shocks that have come in that are masking, in my view, this underlying, the economy's pretty strong, and I feel like eventually we are going to be back to rates can come down a fair amount. But in the near term, I'm a little uneasy front loading too many rate cuts and counting on this will be transitory and inflation will go back down.
Well, let's talk about one of the issues that I've heard you talk about, which is the uncertainty of making these decisions based on the lack of regular data.
Yeah, right.
You know, for example, there's no October jobs report that's going to be given. So how is this impacting your forecasting? And for those in the audience who are trying to do forecasting.
Badly. Yeah.
Well, any recommendations about how to make it better?
Okay. My recommendation is it wasn't because of the government shutdown. So in the government shutdown, they stopped sending out the price inspectors, who the BLS employs thousands of people who go out and check on the prices of identical goods each month, and that's where the inflation rate comes from. They do a survey of tens of thousands of people, the current population survey, that's where the unemployment rate comes from, and they talk to employers, and that's where the monthly jobs numbers come from. All of those shut down. They shut those down in the government shutdown. Both the September reading, they had it, but they didn't release it because the person whose job is to release it was not working. But in October, when they would send out the price inspectors, they weren't working. So we're just never going to get a job report or a CPI report for the month of October. This is a mess. This is a big mess because the lights went out. And as I described with CPI, if you looked at some of the components, like the services component, it wasn't looking that great the last readings we got right before the lights went out. You know, it was kind of if you looked out in your lawn and there was a bobcat, the last thing you saw was a bobcat sitting on your lawn. You know, like, are you going to open the door? Oh, Fluffy, go on out. You know, let's get another reading before we do that. The Chicago Fed, not because of the shutdown, but because we wanted more real-time data, had been working for months on alternative labor market indicators. And the timing just ended up being very favorable. So if you're into that kind of thing, I recommend paying attention to these labor market indicators, where we take 11 sources, private sector and public sector, and use them to predict what will the next unemployment rate be, what will be the hiring rate among the unemployed, and what will be the layoff or separations rate for people who have a job. It was triumphant to announce, we have a number, nobody else has a number. And it was less triumphant, and the number shows no change. You know, and so that's where we were. That's all we can do, is get out in the district and talk to people. We always do that because the data always come out with a lag. So if you need real-time information, we're talking to our business contacts and our civic contacts to try to get the most current information. And we have to lean on that more. And there's a subtle point. Maybe you don't care. Maybe it's too subtle. But I will say, when the government data are shut down, we still have a number of observations about the labor market. Okay, the Chicago labor market indicators, but ADP puts out numbers. You get a bunch of numbers that at least tell you something about the labor market. The private sector information about inflation is extremely limited. We get some numbers on car prices. We get some numbers on house prices, but that's mostly it. So there is a subtle thing that I have thought that while we were in the dark, it made me more paranoid about the inflation side of the ledger than the job market side. Because if the job market side started falling apart, we get still, for example, the new unemployment claims. That's done at the state level. So if the job market started falling apart, you would still likely see that happen in real time. If the inflation part started falling apart, you really wouldn't see that for months until the government data kicked back up again. So it made me a little more, even a little more uneasy.
So you have some information, but not enough.
Yeah,
and not
definitely not enough. And look, make no doubt about it. The government statistics, yes, they've gotten noisier over time. The revisions have been bigger over time. But the Bureau of Labor Statistics and the U.S. Census are the absolute highest standard of data quality in the entire world. Other countries try to copy what we do, and almost all the private sector information ultimately has to benchmark off of the U.S. government information to make it nationally representative anyway. So without that, we could go for a month or two and still be pretty accurate. But if the government data were shut down for a year, then forget it. Nothing you're finding is likely to be nationally representative.
We've sort of talked to about this already, but when we talk about the labor market, how do you view the current and future state? Do you think it's a slowdown, moderate strength in terms of the supply of workers and the demand for labor? And then how do you see immigration, tariffs, or technology impacting the labor market? That's obviously a big question, so just pick any one you want to answer.
Those were three big questions.
Yeah, three big ones. You don't have to answer all three.
What we have seen, let's call it the last 6 or 8 months, is a notable slowdown in the number of jobs net created per month in the payroll employment. And historically, that is a very good indicator of where you are in the business cycle. Okay, so if you take a step back and say, how does the Fed work? Why is the Fed and monetary policy the point person for economic stabilization? A, it's because we meet every 6 weeks. B, it's because the most cyclical sectors are also the most interest rate sensitive. And so the Fed has very blunt tools. It's kind of just one screwdriver. We can tighten, we can loosen. That's all we can do. But it usually works because housing construction, consumer durables, autos, appliances, business investment, each of these are the things that are normally make up the business cycle. When you go into recession, that goes down first. When you're in a boom, that goes up the most. And so if it looks like they're overheating, tightening the interest rate kind of cools them off, and vice versa. In environments with big changes in immigration especially, monthly payroll job creation ceases to be a great indicator of where you are in the business cycle. And we saw this on the other side in 23 and 24, where we had massive amounts of undocumented immigration, more than we knew in real time. And we started getting these really big job growth numbers, 150,000 a month, 200,000 a month averaging, well above what we consider the break-even rate. And so then there was an argument both in public and at the FOMC over, do these big numbers mean the economy is overheating? In a normal time, if you saw big numbers like that, it means the economy is overheating, so inflation's about to come booming back. Not only was it not overheating, the inflation rate fell almost as much as it's ever fallen in a single year, and the unemployment rate was going up. So that seemed confusing until you realized, whoa, labor supply, basically the population growth rate was just not what we thought it was. So 150,000 a month doesn't mean what you think it means for the business cycle. Now, with immigration slowing, we've seen payroll employment slow way down. But does that mean it's a recession? I'm a little dubious because in the 23 and 24 period, we saw that rates, the unemployment rate, the vacancy rate, the hiring rate, the layoff rate, those were better indicators of the business cycle. And they were pretty steady, and they remain pretty steady. The unemployment rate is up a little. The hiring rate is low, and new graduates, you can feel that, but it's been pretty steady. And the layoff rate is actually extremely low. So you'll see people talking about a low hiring, low firing environment. But just note, that's weird. You usually have low hiring, high firing. That's a sign it's a recession. Or the opposite. Everybody's hiring and nobody's firing. That they're both happening at the same time, to me, that's a sign of uncertainty. You know, as you said, the uncertainty.
So we don't have a lot of time left. We're going to take a few questions, but before we do that, let's just turn for a moment to the Midwest. You know, we know that that your Fed covers most of Indiana and the Midwest, and you've already mentioned the fact that we're the most manufacturing intensive area. We're the most manufacturing intensive state, actually, in Indiana, and obviously a significant region for agriculture. When you think of the factors we've already covered, whether it's inflation, interest rates, the labor market, what do you think are the most impactful to this region? And maybe that's kind of like asking which one of your children do you like the best. But how do you think we should be thinking about that in the Midwest?
The first thing you should know about the Midwest is because we're so manufacturing intensive, and several of those most cyclical sectors are manufacturing, a lot of times 7th District, that's Chicago's the 7th District, we're kind of viewed as canary in the coal mine for where we are in the business cycle. They will say, they will ask me, what are you hearing from manufacturers, from makers of consumer durables and stuff like that? The issue of tariffs massively affects us. I mean, it does affect the economy, but it affects us more than anyone. I saw an analysis of whose exposure is greatest, rank all the states by tariff exposure. Of the 7 most exposed states, 4 of them are in the district, and Indiana was number 2. Michigan was number 1, and Indiana number 2. So as we make decisions about that, agriculture, manufacturing very much affected. Much of the Midwest, we've been dealing, not just recently, we've been dealing for some time with population growth slower than the rest of the country. So that's an extra consideration that makes it a little hard to analyze. I know it's tougher on the state governments in an environment like that, but it also makes it hard to tell kind of this same question of per person is a measure of your economy. If you saw GDP growth for Michigan or Indiana or Illinois is slow, how much of that is just because population growth is slow versus the economy itself is not growing?
So we had several questions that were offered by the audience. We probably won't have time for all of them, but a couple interesting ones. One of them was, the Fed is one of the last apolitical government entities. How does it remain that way, or does it remain that way?
It better remain that way. I agree with that statement. And as I said before, the people around the table take the job extremely seriously. It is not, you can see when the transcript comes out, and you can see from the minutes, it's not about elections. It's not about politics. It's not about anything but the state of the economy and the outlook for the economy. And that's what it should be. Now, before I ever got to the Fed, I'm just a research economist. Economists are basically unanimous that the central bank must be independent from political interference when setting interest rates. That's what Fed independence means. When people say Fed independence, it's not anything other than that. It's just if a sitting government can tell the central bank what to do with interest rates, just look around where they have that. Inflation comes roaring back, growth is slower, unemployment is worse. So I was part of that unanimity that it's critically important. It would pain me, and it would pain markets, I think, if we move to a different environment than the one we're in. I'm not worried. People ask me, are you worried about that? I'm not. And the reason I'm not worried about it is I go to every meeting, FOMC meeting, and I'm telling you, people take the job extremely seriously, and it's not political in that election sense. I would say you're out of the elections business. You're out of the fiscal policy business. We're just working on monetary policy. If that truly is threatened, that would be a big mistake. It'd be a really big mistake.
Another question, do you see two divergent economies with data centers / AI versus every other part of the economy?
Kind of, yes. Okay, so the data centers, as you know, they're booming like crazy. It's made it a little harder to gauge where we are in the business cycle because I told you, one of the 3 big cyclical things is business investment. So if you're trying to figure out, are we about to go into recession? You'd be like, is business investment slowing? Business investment not slowing at all. The data centers are off the chain. Everywhere you go, they're driving up the price of electricity. Nobody can find an electrician. Nobody can find space. And so I do think there are, for sure, different sectoral parts of the economy, though it's always true. Maybe not always as extreme as the AI boom. And that extremeness does raise a lot of concerns about, well, is that a bubble? And if it were a bubble, then what would happen? Would it be like 2000 and 2001 where the internet was growing and then suddenly they realized it's not going to grow 30% per year, it's going to grow 7% per year, which is still pretty strong, but they had built all of this infrastructure, assuming the other. For the time being, I think that question is pretty persuasive and perceptive, that anything touching on AI is booming like nuts, and there are other parts that have definitely been slower.
I think this one probably doesn't have as much steam as it did, but it's about the 50-year mortgage option
Yeah.
that's been raised. And do you see that as a view that the Fed would be looking at, or is that something that you would even be involved with?
I don't think the Fed would be involved with it. In a way, it doesn't seem like fiscal policy, but in my world, that's fiscal policy. It's something to be decided by not us. You know, our thing, if it's influencing prices or employment, then we are thinking about it. In this, I probably wouldn't like to have a mortgage hanging on my head for 50 years, but if the financial innovations have happened a lot over the decades. We've had periods with a lot of fixed rate mortgages. We've had periods with adjustable rate mortgages. We've had all different kinds of things. So whatever it is, I always say our motto at Chicago Fed, like the rest of the Midwest, there is no bad weather. There is only bad clothing. You tell us the conditions and we'll tell you what jacket we need to wear. And how the mortgages are set just goes into background conditions. Now, I do think it would affect monetary policy in the following sense. One of the main channels, one of the mechanisms of how we affect the economy is through interest rates. We set a short rate. They flow through into mortgage rates. If you have a 50-year fixed mortgage, you're going to be less sensitive to shifts in the short run interest rate. We already see this with the rise of 30-year fixed mortgages. It just kind of got a little duller. That transmission mechanism got a little duller. So if everybody shifted to 50-year mortgages, right, I think short run interest rate decisions would have less impact.
Which we know they wouldn't.
Which they wouldn't. That's what I was going to say. This policy's up for grabs to begin with, and even if you introduce something new, it's usually decades before everybody adopts it.
Well, I think we have run out of time. Any final words or predictions you'd like to make?
Go Bears, go Colts. You know, let's have a Super Bowl in the 7th District. That would be awesome.
Well, we are so grateful to have you here with us.
Yeah, it's great to see you. And look, the sophistication of this audience and the I always say, they asked me when I first got there, are you a hawk or are you a dove? And I said, I don't even know if I like birds. I aspire only to be a data dog. And the CFAs of the world, you're data dogs with us. And so thank you for everything you do.
Thank you.